Hi, everybody, and welcome to our last chapter, chapter 23. And here we're going to look at full disclosure in financial reporting. And our learning objectives include number one, reviewing the full disclosure principle and describing how it is implemented. Number two, we'll be discussing the disclosure requirements for related party transactions, post-balance sheet events, major business segments, and interim reporting. Number three, we're going to identify the major disclosures in the auditor's report and understand management's responsibilities for the financial statements. And number four, we'll identify reporting issues related to fraudulent financial reporting and financial forecasts. So as we preview chapter 23, we're going to look at the increase in here in reporting requirements, differential disclosures, notes to financial statements, and then some of the disclosure issues to related parties, post-balance sheet events, diversified companies, and interim reports. And as we look at the MD&A, the management's reporting here for full disclosure, we have our auditor's report and the management's report. And our current reporting issues include fraudulent financial reporting, internet financial reporting, reporting on forecasts and projections, and finally, the criteria for accounting and reporting choices. All right, let's get into the meat of the chapter. Here, we're going to review the full disclosure principle and describe how it is implemented. The full disclosure principle calls for financial reporting of any financial facts significant enough to influence the judgment of an informed reader. Some of the financial disasters at MicroStrategy, Farmore, WorldCom, and Theranos highlight the difficulty of implementing this full disclosure principle. All right, so this arrow here represents all the information useful for investment, credit, and similar decisions. And then this arrow represents just the financial reporting, and this arrow represents the area directly affected by existing FASB rules, and then this arrow represents our basic financial statements. So our basic financial statements here, we have our balance sheet, statement of comprehensive income, statement of cash flows, statement of changes in stockholders' equity, and the notes to the financial statements. Those include accounting policies, contingencies, inventory methods, the number of shares of stock outstanding, and alternative measures, fair value of items carried at historical cost. Now, if we look at one additional box here on supplementary information, examples of that include changing prices disclosures, oil and gas reserves information. And if we expand it one more box to all financial reporting, we have other means of financial reporting. The MD&A, management discussion and analysis, letters to stockholders, and sustainability reports. And lastly, other information could include a discussion of the competition and order backlog in SEC forms, analysts' reports, economic statistics, and news articles about the company. So that's a variety of different types of financial information. All right, why would we want to have disclosure requirements? First reason is the complexity of business environment. The increasing complexity of business operations magnifies the difficulty of condensing economic events into summarized reports. Such areas as derivatives, leasing, business combinations, pensions, financing arrangements, revenue recognition, and deferred taxes are complex, as you know, especially from the work you've done to date in this course. The companies extensively use notes to the financial statements to explain these transactions and their future effects. The second category here, necessity for timely information. Today, more than ever before, users are demanding information that is current and, of course, predictive. For example, users want more complete interim data. And as you would know, that's data that's disclosed other than at the end of the year through our annual reports. Also, the SEC recommends enhanced fair value and sustainability disclosures. And lastly, accounting as a control and monitoring device. The government has recently sought public disclosures of such phenomena as management compensation, off-balance sheet financing arrangements, and related party transactions. The SEC has selected accountants and auditors as the agents to assist in controlling and monitoring these disclosures. All right, differential disclosures. Big gap versus little gap. Number two, FASB has traditionally taken the position that there should be only one set of generally accepted accounting principles. The FASB is working with an advisory committee to explore ways that its standards can be more cost-effective for all companies, regardless of size. So we certainly do not want two sets of generally accepted accounting principles, one for the big companies and one for the little companies. Notes to the financial statements. These are a means of amplifying or explaining the items presented in the main body of the statements. Accounting policies. Here, number one, companies should present a statement identifying the accounting policies adopted and followed. And number two, it should present the disclosure as one, a first note, or two, a separate summary of significant accounting policies section preceding the notes to the financial statements. Okay, major disclosures for inventory. Inventory here, the company should report the basis upon which inventory amounts are stated. For example, lower of cost or market, net realizable value, or lower of cost or net realizable value, and the method used in determining the cost, LIFO, FIFO, average cost, etc. Manufacturers should report, either in the balance sheet or in a separate schedule in the notes, the inventory composition, i.e. the finished goods, the work in process, or raw materials. Unusual or significant financing arrangements relating to inventories that may require disclosure include transactions with related parties, product financing arrangements, firm purchase commitments, involuntary liquidation of LIFO inventories, and pledging of inventories as collateral. When we did chapter 7 and 8, those illustrated those disclosures. Property and plant and equipment also have some unique disclosures. Companies should state the basis of valuation of property, plant, and equipment. It is usually historical cost. Companies also should disclose pledges, liens, and other commitments related to those assets. In the presentation of depreciation, companies should disclose the following in the financial statements or in the notes. Number 1, depreciation expense for the period. Number 2, balances of major classes of depreciable assets by nature and function at the balance sheet date. 3, accumulated depreciation, either by major classes of depreciable assets or in total at the balance sheet date. And 4, here, a general description of the method or methods used in computing depreciation with respect to major classes of depreciable assets. Finally, companies should explain any major impairments. When we did Chapter 10, that illustrated property, plant, and equipment disclosures. Creditors' claims. Here, investors normally find it extremely useful to understand the nature and cost of creditor claims. However, the liabilities section in the balance sheet can provide the major types of liabilities only in the aggregate. Note schedules regarding such obligations provide additional information about how a company is financing its operations, the costs that it will bear in future periods, and the timing of future cash outflows. Financial statements must disclose for each of the 5 years following the date of the statements the aggregate amount of maturities and sinking fund requirements for all long-term borrowings. You'll remember from Chapter 13 where we illustrated those disclosures. And equity holders' claims. Many companies present in the body of the balance sheet information about equity securities, the number of shares authorized, issued, and outstanding, and the par value for each type of security. Or companies may present such data in a note. Beyond that, a common equity note disclosure relates to contracts and senior securities outstanding that might affect the various claims of the residual equity holders. An example would be the existence of outstanding stock options, outstanding convertible debt, redeemable preferred stock, and convertible preferred stock. In addition, it is necessary to disclose certain types of restrictions currently in force. Generally, these types of restrictions are going to involve the amount of the earnings available for dividend distribution. And we covered examples of these types of disclosures in chapters 14 and 15. Contingencies and commitments. Here, a company may have gain or loss contingencies that are not disclosed in the body of the financial statements. These contingencies include litigation, debt, and other guarantees, possible tax assessments, renegotiation of government contracts, and sales of receivables with recourse. In addition, companies should disclose in the notes commitments that relate to dividend restrictions, purchase agreements, throughput and take or pay, hedge contracts, and employment contracts. Disclosures of such items were illustrated in chapters 6, 8, and 12. That looks like a good place for us to stop this video. And when we return, we'll take a look at major disclosures for fair values. Until that time, bye for now.